Hey YouTube, welcome back to another episode here. I am here with Ashley Wilson, founder of Bar Down Investments. So Matt and I just signed documents to close on our 136 unit property that we're closing on next week. So one thing that we were talking about, we just got a call. Our lender is kind of changing the requirements that they have for the insurance. We have two buildings that are in a flood zone. We also have an issue where a lot of our units have these old school electrical panels. That's something we're gonna be able to take care of right away, probably in the first 60 days, and that will drop our insurance costs. But Ashley was telling me, man, I got to tell you everything I know about flood insurance. And so I said, Ashley, let's get it on the camera so we can record. So tell me, well, why don't we start off, give our audience a little bit about you, and then we'll get into the fun stuff.
Hi everyone, I am Ashley Wilson, and of course I was just introduced obviously by Justin as I'm the co-founder of Bar Down Investments, and we do exactly what you guys do, the DeRosa Group does, which is acquire large multifamily properties, which is why I know so much about insurance with large multifamily, specifically flood insurance. Well, the changes that have happened over the last year have made it very difficult for people to continue acquiring properties that are in flood zones. And the reason being is there are two factors that are significantly impacting the flood insurance rates. First and foremost is the change of weather patterns and the risk of claims on these properties because of climate change. If you believe in it or not, that's not the point. The point is that there are tremendous storms that are impacting our country and thus the properties. The second major variable is with respect to the construction cost. The replacement cost is at an all-time high, especially now more than ever because of chain supply issues and shortages. Labor shortages also make that even further compounded. So in essence, the insurance companies have to account for those two variables, and that transacts directly into the rates that we're paying. Last October, there was a change with FEMA with respect to the rates. So there are two different types of insurance that people think of when they think about flood insurance. First is what's called Flood One. Flood One is government-backed insurance programs that you put on your property, and that speaks to the loss of value, the claims that you have if you were to lose a building due to some sort of issue, namely in this situation, weather-related, because we're speaking about flood. So FEMA had a program, it was called FEMA 1.0, and that was the program that all properties that required flood insurance prior to October was under. But FEMA in October came out with a new program, FEMA 2.0. That new program significantly increased the rates of the premiums, and therefore that transacts into what you can pay for the property because it directly impacts your P&L and therefore the value of the property. So the FEMA 2.0 program is significantly higher, and if you are under FEMA 1.0 coverage, when you go to sell that property upon renewal, you typically go into FEMA 2.0, which is a significantly higher rate. To put that in terms of a dollar figure, we were looking at a property where the rate per door for insurance, with all insurance included, so that is your property coverage, your umbrella, your general liability, and flood insurance, was $965 a door. To purchase that property and renew all of those policies, they all stayed at the same rate except for flood insurance, and it went up to $1,700 a door under FEMA 2.0. It killed the deal. So in terms of the second level of flood insurance, the second level of flood insurance is with respect to loss of business income. Loss of business income for properties that are impacted by the flood is a really good bet, because obviously if you're impacted by the whatever the catastrophic event is, that you can sustain paying for your mortgage and all other expenses while that unit or units are being rebuilt. Flood 2.0 is actually traded on the private market, so those rates aren't regulated by the government, but Flood 1.0 ties into the FEMA programs, and that's what the lender requires you to have if you are sourcing debt from a lender as opposed to paying for a property in cash. Because of that, people have had to adjust, retrade, and possibly even walk from deals. I spoke to one insurance broker who told me that since October, every single property that has been under flood insurance 2.0 program has fallen out of contract because they couldn't get the deal to work. So it's really important to recognize this, because the alternative is that if you are under Flood 1, FEMA 1.0 program for your Flood 1, FEMA 1.0 program you can access that that rate when you transact if you absorb the current owner's coverage, and that doesn't mean absorbing their entity that owns it. You can still transact and be under FEMA 1.0, but the government has set an annual renewal rate up to a max of 17% per year increase until they get to the FEMA 2.0 rates. Obviously, people are very upset by this. Most notably, the governor of Louisiana has been petitioning the government, rallying all different state representatives to go up and lobby in Washington for these rates to be changed. So it obviously remains to be seen whether or not this is going to happen. But for now, it is making it very difficult to acquire properties that are in flood zones. I mean, they were difficult to sell before, but in terms of the financials behind it, it's even more challenging.
So what, if anything, can we do? 17% increase to get up, on phase 1 or Flood 1. That's tough, but that sounds better when you put it in the context of almost doubling from 900 to 1700, right? So can I model out that 17% increase? How do I stay there versus going into Flood 2?
So in terms of getting the renewal 17% year over year, you have to model out what year can you go to before you would have to then be, negative cash flow or, not hitting your projections. But you also have to model it out on the sale, because you obviously can't sell the property for the same value as before, because your next buyer will have to deal with that issue too, right? So I think for now, it's a matter of this seller also being educated on this new situation with their property. There's always a way, and because this is still relatively new, there will be ways, like for example, the tip I gave before of absorbing the current owner's policy. You can do that by working through the insurance provider who provided the insurance from the current owner and working with them to originate your coverage. So that's a good way that you can, in the interim, be able to still move forward with the transaction as we wait to see what happens with these rates. Personally, I don't think these rates can be sustained, but at the same time, they have to protect themselves too. So what is going to give, I really don't know.
Right. Where does that money come from? I don't know where it comes from and how we continue at rates going up that much.
I honestly don't know. It's so shocking to me. And this isn't affecting just commercial real estate. This is affecting single family real estate as well. So that's why the governor of Louisiana is so drawn to this issue, because he is personally seeing a lot of homeowners be significantly impacted where they were only paying a couple $100s a year to now paying that over that a month. And that has been extremely challenging for homeowners. I mean, it could literally force them into being homeless because they can't even sell their property.
Right. Stuck.
You're stuck.
Right. There's nowhere to go.
And they can't afford their property either because they can't afford the insurance. So it's a very vicious cycle.
Right. Well, guys, stay tuned for more information on that as more comes out. Thank you, Ashley, for the deep dive on insurance. So moving forward, are you just avoiding flood zones? Are you just not buying in flood zones? What's the plan?
So we are only interested in buying in flood zones if there is a way in which, and we've talked about this before, but if there's a way in which we can elevate one of the units that are, if the building is able to be raised outside of the flood zone, that is another way that you can creatively remove it out of the flood zone, and that way you can have your property exempt from needing flood insurance. Of course, that takes a lot of time,
Right.
because flood maps need to be redrawn, and there are special people who specialize in this service. There's also special people. They're really helping out as well. But there are people who specialize in this service, and they help redraw the flood map lines and help tell you. They look at topography studies from engineers who are looking at where the floodplains lie and how much your building needs to be, raised. And then there are also certain companies that do this as a specialty of raising these buildings to make sure, you have to be very careful when you raise a building. A lot of things can go
Especially
awry.
older build, 70s build buildings,
Yes.
that's going to be tough.
It's very tough.
But something to consider, it might be cheaper to raise your building out of the ground
Yes.
than to pay for the flood insurance. So consider all possibilities. It's a
Not
really good
even
tip.
not even to pay for the flood insurance, but on the exit out.
Right.
You're talking the difference between several millions of dollars. Remember, your NOI is a indication of the value of the property. So if your NOI is being hit, it could be, exponential, millions and millions of dollars. So it might be worth it to raise the building if you're able to do so.
Love that tip. Ashley, thanks so much for coming on, sharing
Thank
with
you
us.
so much for
Hope
having
you
me.
guys enjoyed that deep dive on a little bit of what we deal with as asset managers in the multifamily business. Please like, subscribe, and share this video. Leave us a comment below if you have any questions. We'll get Ashley back on to answer some questions for you. Thanks so much.